October 20th, 2023. We tried to get a leg one, leg two measured move today. Came up a little bit short at the end of the day, but I think that's the magnet that we were looking for. And, I don't know what the Globex session looks like. I haven't checked it, but 42, 44. So maybe we hit it. We got pretty close, anyways. Um, over the past couple, coming in today in general, over the past couple days, we've been pretty oversold. You can see we had this bear channel line and we broke below the bear channel line today. And something I haven't been very good about lately is being open to everything. Generally you're going to get a bounce after you've had a tight channel for a couple days or a tight bear channel for a couple days. You're generally going to get a bounce. Channels generally last 2 days or 150 bars. Um, that's the largest channels, at least. So I kind of came into the day with a bullish bias, which is fine. You want to come into the day with a bias, but I need to do a better job of getting short when the market's going down. I thought 6 was a reasonable sell for a swing. It's an inside bar. And we had a very small opening range. And a lot of times when you have small opening ranges, you get trend days. So generally, smaller opening ranges lead to trends or trend days. These trend, 2 legs up, 2 legs up. That was a trend beginning of the day, and big reversal. But generally, smaller opening ranges lead to trend days. So one, or it increases the chance of a trend day. I shouldn't say they usually lead to it because that's not necessarily true. Bar one, bear bar, but very small tail on the bottom. So there's buying pressure on it. Not a very good sell. We're also, again, we're on this bear channel line right now. Coming into the day, we're on the bear channel line that we've been on for the past couple days. So I don't think it's all that good to be looking to sell anything here. Bad follow through on 2, which is expected. Bad follow through on 3. So very tight trading range. A lot of doji so far. Bull bar on 4, but not quite closing near its high. Even if it was closing near its high, it's a pretty risky swing trade. With this tight trading range on the open and the past couple bars from yesterday, the most likely scenario is we're going to go sideways. So I think it makes more sense to wait and see if you get follow through on 5. And with the tail on top, that's also disappointing. And we're at the top of a tight trading range. So bulls who bought below 3, hoping 4 was going to be a big bull bar, are a bit disappointed about the tail on 4, and they're disappointed it wasn't an outside up bar. So a lot of them sell to their longs, and that's what causes 5. There are buyers below 1, so we get a big pullback on 5, and then a bear bar closing near its low on 6. 6 is an inside bar, and generally inside bars in the opening range are reasonable swings. I have a couple examples of inside bars as the opening swing. This was one. This was one. So inside bars, around the open, here was one. Will oftentimes essentially become the lows of the day. So when you get an inside bar as the opening swing, a lot of times, if it's a bear inside bar, obviously it'll stay, the high of the day will stay. And if it's a bull inside bar, the low of the day will stay. So that is if it starts to go in your direction. So I think it's a reasonable sell below 6. The problem with 6 is you're selling a breakout of a pretty overdone channel. So it's most likely going to end up reversing. And it's down on 5, up on 5, and down again on 6. So it's potentially a 2-legged trap at the bottom of the trading range. But it's a low probability sell. So if you're selling there, you're hoping you're going to get immediate follow through, which you got pretty immediate follow through. But if you're selling down here, you're hoping for fast follow through. You really don't want to see a bull bar. If you saw a bull bar here, most traders would probably just get out above it. Follow through on 7, but it's not that great. Big tail on the bottom and the top. So, I think it's enough that if you were short below 6, it's still logical to stay short because your premise is still valid, but you should definitely be getting worried. Then you get good follow through on 7, on 8, you get good follow through. So good for the bears. And then even more follow through on 9, but it's parabolic. You can see the channel line gets steeper as it goes, and that means it's parabolic. So hard to want to sell at the close of 9. You do have an open gap with the low of 7 and the high of 9, but there's no clear open gaps here. They're quote unquote clear, but they're not as obvious as gaps usually are on trend days. So that made me pretty suspicious about this trend, along with what I already mentioned. But price is truth, so probably would have been better. I did not sell 6, obviously, like I think I already said that. But I think that's a good sell and probably okay to sell to close these bars. Bad follow through on 10 for the bears. It's a low one short. It's not quite an inside bar. But generally, when you get a doji, sell to close trend, the trend is going to end within 3 bars, or it's going to start to go more sideways within 3 bars. So you can see we got a spike phase, and then a pullback, and then a channel phase. So the doji normally means it's not. This is now not as strong as it was. So you're expecting a channel. 11, follow through for the bears who sold below 10. Not a great sell, but it is a low one short in a bear trend. More follow through on 12, but these bars are noticeably smaller than these bars. And then we got 13. And 13, I think, is interesting because you're in a bear micro channel from 5 to 12. So it's a 7-bar bear micro channel with pretty much all bear bars in a doji. So you know the first reversal up on 13 is likely to fail. So what some bears will do is they'll sell above 13. You see it went one tick above 13 and bears sold. Bears will sell above 13, knowing that if 14 is a bull bar and it's good follow through, they can probably scale in higher or they can just get out. But a lot of times the reversal is going to fail. Vast majority of the time, the reversal is going to fail in some capacity, and they're going to get back to a new low. So this was like best case scenario for the bears who sold above 13 was 14. But I think this is strong enough to get a second leg. So 13 is not a good buy. 15, follow through for the bears, but not all that great. If you're selling below 14, you wanted another bar that looked like 14. You wanted a big collapse, and you're just not getting it. 16, bull bar closing near its high. And after this first reversal has failed, we're no longer in that bear micro channel. So I think it's potentially okay to buy above 16 for a swing. Additionally, you might have some bears who sold below 14 and some bears who sold below 15 since it's consecutive bear bars, although it's not all that good. You get the reversal up. So bears know that there are bears who are disappointed in what happened here, and they're willing to get out of their, they're going to sell out of their shorts. They're going to buy back their shorts, I should say, above 16. So what bears will do is they'll sell the close of 16, put a stop one tick above 16, and try really hard not to let it trigger. And you can see, I don't know if you watched bar 16, or bar 17, but it traded down to the 15 close and then initially bounced, meaning that when it traded down to that 15 close, bears who were short here were let out at break even. And so since they were let out, this was no longer as strong. So traders were no longer willing to buy above it. So it just ended up never triggering. More follow through for the bears on 18, but not all that good. And then another reversal up on 19. It's consecutive sell climaxes over the past couple of days. And today you could argue spike and then a 3-push channel. So maybe you buy above 19, but you have to recognize this channel is really tight. So it's probably not the best idea. It's still most likely always in short. And if you do buy above it, you need to realize it's a scalp. It's probably only going to the moving average at best. So when you get bad follow through on 20, I don't think your premise is valid anymore. You're hoping we're going to get a quick reversal up, and 20 was your chance to do that. 20 needs to look like 28. You need big bull follow through, basically up to the top of what this is probably where the trading range started, the first pullback. So, and you can see that's where 31 it tested the first pullback. So oftentimes when the channel starts, the beginning of the channel is a target. So we had the spike and then the start of the channel here. And oftentimes the market forms a trading range around the open of the channel. But I was saying bad follow through on 20. So a lot of traders are disappointed in 20 and they'll sell out of their longs on 21. Any traders who were long, stay long on 20, disappointed 21, sell out of their longs during 22 around break even. And that causes this. More follow through on 23, but there's a lot of tails on these bars, so it's not all that good. And then a doji on 24. We're probably not going much lower. It's okay to be short, but most likely we're not going to go very much lower. And, if you get any sort of bull bar, just get out above it. And that's what traders start to do. So you get some follow through 20 for the bulls on 26 above 25. Anyone who sold above 25, disappointed 26 is getting out around that high during 27. And traders start buying back shorts in panic, causing 28. You could buy 28 because always in bears, if you're still short for any reason, you're going to get out above 28. So there is logic to buying above 28 for a swing, but there are a lot of problems with it, with how tight this channel is deserving a second leg. We're probably going to stall at the top of this trading range. So there are a lot of issues with buying above 28. Some follow through on 29, but tail on the top, tail on the bottom seems to be failing at the moving average. And a big bull bar at one point on 30, but it gets sold off. So bulls were hoping we were going to go straight up. It doesn't appear that we're going to go straight up. So what they're going to try for now is a trend line break here, a pullback, and then hopefully a higher low major trend reversal. And I have examples of trend line breaks. I know I'm showing a lot of these today. I'm sorry. But I just think they're cool. So you can see here, trend line, and then attempt, but failure, trend line, and then higher low, major trend reversal, and we got a big rally. This is not as good of an example. This was today. This was the opposite direction. So we had a trend line break, and then a higher high. And generally, when you get the higher high, major trend reversal, you're going to end up getting a higher or a lower high. So we got the higher high major trend reversal, and then we ended up getting the lower high, and then you can sell below the lower high below 50 for a swing. This, you can see trend line break, lower high, major trend reversal. So bulls were hoping something extreme was going to happen, right? They were hoping they were going to get a big sell off, or sorry, a big rally, similarly to here. They were hoping for a big rally like that. And they got essentially, so I'll go back to 31. But on the close of 31, you know that we're probably going to pull back and get some sort of higher low major trend reversal. So basically at this point, you should be pretty much looking to buy above any bull bar that closes strong. Follow through for the bears on 32. It could be one pullback two, so it could be a second leg trap. And you're also towards the bottom of a trading range, so it's not all that great to sell below 32, though it is reasonable because it is a second strong bear close. Occasionally you'll sell off here. But if you're doing it, you're probably going to want to get above any bull bar or any bar in general because you don't want to sit through a pullback. Think about it. If this pulls back, your premise that we're going to collapse, because that's your premise if you're selling below 32, your premise probably isn't all that valid. Bad follow through on 33. It's not the worst follow through. It's a bear close, but you wanted another big, strong bear bar, and then you get 34. And any bears who are short for any reason are going to exit above 34. It's that higher low major trend reversal. It's a good bull bar. Bulls are going to buy. And this is a combination of bulls buying and bears buying back shorts. So you get big follow through on 35. This is the neckline of the double bottom, essentially. So bulls want to get a strong close above 30 to confirm their breakout. I think 36 is a big problem for the bulls. You get a big bear bar closing near its low, so it could be two legs up and a potential, leg one, pullback, leg two, measured move down. But it does something interesting. The same way over here, we talked about bears sold the close of this bar, trying not to let it trigger. Bulls bought the close of 36. They know always in bulls are going to exit below 36, and always in bears are probably going to short below 36. And if we trade below 36, it's very possible we're going to get a couple legs sideways to down, and bulls won't look to buy again until we do. So they buy the close of 36, and that creates a good bull bar on 37. And you can see we get a good bull bar on 37. It's an inside pattern, right? 36, 37, II. So basically breakout mode. And bulls were hoping we were going to get good follow through on 38 and a close above 30, but we just didn't. And it's disappointing to see a bar like 38. You wanted a strong close above 30 because that's essentially the neckline of the double bottom between 28 and 34. So they wanted a strong close above the breakout point. And now we've tried this time to get above here, and we've tried this time to get above here. And when you try it twice to get a breakout of something and it fails both times, that's a problem. And then we get 39. And kind of the same situation as 36. I think a lot of traders would exit below 39 if it triggers, but it never does. And we get a big bull bar because bulls bought the close of 39, trying not to let it trigger. We get a big bull bar on 40. But at this point, bulls aren't, they're not believing in this trend as much, and they're starting to look at these moves to extremes as places to scalp out. If this is going to be a bull trend, it needs to get really strong really fast. And again, 40 doesn't trigger. You get 41. And then you get a big bull bar on 42. But at this point, bulls are probably pretty fed up with this this trend. They've been had a couple chances where they've, here they say, okay, give me another bull bar. Let's get more follow through. And they don't get it. And they're disappointed once. But it doesn't trigger, so they're willing to give it another chance. They see 37. They say, okay, well, give me the follow through. Give me a good bull bar here. And they're disappointed again. And it's like, okay, well, and then you see 40. And again, they're still in because none of these sells have triggered. So always in bulls are still long here. And they're saying, okay, well, give me a strong close now. And you get the strong close and you start to think, okay, well, if we rally above 40, I think a lot of any bears who are shorting for any reason might start to cover above 40 and we could get a quick rally. And then you get 41 and bulls are disappointed again. And you get a good bull bar on 42, but it's got a big tail on the top. And at this point, it's 3 or 4 pushes up. And this is probably just a trading range. And with this tail on the top, traders see it and they decide to just scalp out at the high. And that's what causes 43. And then any bulls who held long are going to exit below 43. Hence why 43 is a reasonable swing trade, short for a second leg down. Additionally, today's sell-off was about 25 bars and the pullback, 17, 18 bars. So I guess that isn't the best example of the point I was going to make. But generally, a lot of corrections are about half the length of the overall moves. I suppose you could argue the overall move started here, which is 62 bars. So maybe we got a 30 bar correction. You could argue it started there, the move back down, or you could argue it's here, which is exactly 30 bars. But basically, okay for bears to short below 43. It's a tight bull channel. It could be a parabolic wedge, but it is still a tight bull channel, so you have to respect that. And bears get great follow through on 44. And that's really good for the bears. They get 44. The problem is this channel is pretty tight, but we still might get a second leg down. So it's okay to hold short, thinking that, well, maybe 45 will collapse too, and we'll get a move down. This high has already been tested, but maybe we'll get a move down to a new low. We had 20 straight closes below the moving average, so it's possible we need to retest these lows. And then you get 45, which is an inside bar. And while 45 isn't the best buy, it's probably a reasonable swing buy on the premise that this is a broad bull channel. And so if it's a broad bull channel, we might have to test back up to the high of the channel, and that's what happened on 46. And 46 is so big and climactic because not necessarily because bulls are buying, but bears who sold 43 or the close of 44, hoping that we were going to collapse, disappointed 45, will exit above, looking to get short at a higher price. And that's what caused, it's basically a give up bar. Bears are, disappointed with their follow through, and they're going to exit above 45 and cause the big move up on 46. And 46, again, not able to close on its high, disappointing for the bulls. So any bulls who are buying above here are scalping out on the close of this bar. It's a trading range day, and they got a pretty quick 10 points. So I think they're going to take it, maybe even 15 points. What's the high of this? 71. So it needs to go to 76, 75. Oh, yeah, definitely. 86, 75. So they did not get 15 points, but they got 10. So they start scalping out, causing 47, 48, 49. And you can see there's buying pressure on the lows of all these bars. And when it's doing that, it's doing this. So it's down, up, down, up, down, and then up again. And what does this look like? 1, 2, 3. It looks like a wedge. So, 46, 47, 48, 49 is a parabolic wedge on a smaller time frame. And you get a bear bar on 50, but you're basically trying to sell the breakout below a wedge. And after this probably deserves a second leg up. So I would be resistant to doing that. It's an inside bar, so maybe, but the reality is this is probably getting a second leg up, and I would just rather wait for more follow through. I think that the bull channel is too steep and 45, 46 is too strong. And then you get 51, and what does 51 do? Any bulls who bought the close of this bar hoping they were going to get strong follow through, scaled in lower, maybe a 50% pullback. I'm not sure if that's what we got to, but yeah, about a 50% pullback. Bulls bought the 50% pullback, so they'll buy this close, scale in lower, and they'll exit around the close of 46 during 51. That's what causes the tail, and that's what causes the sell-off on 52. 52, a potential second leg trap, 1, pullback, 2, but I think also a reasonable swing sell. Bears sell it, hoping that we're going to get follow-through like we did on 44. And then they're disappointed on 53 because 53, it's a bull close. If it was a bear close, it'd probably be acceptable to stay short, kind of like over here. It's not the best, but it's okay. But it's a bull close, and bears are disappointed. And so when it gets back to around their entry price down here, they just buy back their shorts, and that's what causes 54. Bulls will see it as a two-legged correction, but I think 54 is more bears buying back shorts rather than bulls buying. So bulls might not be too eager to buy here because it's potentially the top of the trading range. Some bears will sell below 55, thinking that this is a wedge attempt, and maybe we'll get a measured move down of the wedge, which we did. So it's a reasonable sell below 55, but you want to wait, for a better follow through. I personally at least did. You get bad follow through on 56, and then a big bear surprise on 57. 57 makes the market clearly always in short. I think it's an okay swing sell below 57, and you get follow through on 58, 59, and 60. But 58 has a tail on the bottom, which is disappointing, but it's not the end of the world. 59, an inside bar, a doji, but a bear close. So okay, but not great. And then 60 doesn't close below 58. You wanted it to close below that breakout point. So really not all that great. And you can see bears starting to exit disappointed. And that's down here, trying to scalp out at the lower price, thinking that, there's going to be support here since this was essentially a major reversal. There's usually supports at major reversals or major reversal attempts. So that's what happened on 61. Some traders exit, starting to cause the bounce on 62, but not many traders are buying above that with how strong this is. 63, you could argue that it's a double bottom on support. And since the trading range, it might look steep, but nothing is quite as bad as it looks in trading ranges. So the probability might be there. Considering also bulls who bought below 56 might have to get out at break even since they're trapped. And I think they had a chance. There's an 80% chance that if you buy above the next bull bar. So for example, this is a perfect example. When you take a buy like this, a reasonable buy below 56, bulls who buy below 56 know there's an 80% chance if they scale in lower and buy above the next bull bar, they're going to be able to get out at least break even. And there's a 60% chance we're going to get back to this low. So what that means is traders buy below 56, disappointed at 57, 58, 59, 60, obviously. They'll buy above 61 and get out around break even, and that's where that price is. So traders they bought more, they scalped out, and that's causes the selling. 63, double bottom, maybe we have to get back here, but not all that great. Essentially tight trading range, 5-bar tight trading range, and this ends up just being a tight trading range. So that's why you get bad follow through 65, and that's why 66 can't close on its high, because the bulls who bought up here, disappointed in this, are scalping out. 66 not able to close on its low. 67 is an inside bar, but not very good follow through. And 68 is a breakout attempt, but it's a breakout attempt of a tight trading range, so I don't want to take any trades. Bad follow through 69. Bears who sell below 68, disappointed 69, buying back their shorts, causing the rally on 70. Then you get 71 and 72. 71, bears trying to break out, probably going to fail. 72 is interesting. It's later in the day. Generally, if the market's in a tight trading range, past bar 72, you don't want to trade. But, you're buying at the very low of this tight trading range and the low of the overall trading range. So maybe an okay buy above 72, but you need to get out once you see 73. If you're buying above 72, you're hoping we're going to race up into the close and at least get back to this low. And you just don't get that on 73. You get bad doji follow through. And when you get bad doji follow through, what do traders do? They exit. And that's exactly why they bought above here, disappointed this. That's what's causing 74 is traders exiting. It's late in the day too. So traders are quicker to get out of things. And once they're, a lot of traders are out on 74 or below 73. And anyone who's still long on 74 is disappointed in the close of 74, and they just sell out of their longs to the market, and that causes the dump on 75. I think the traders who never mind. I was gonna say I was thinking that if you bought this 72 high, you scale in somewhere, you're probably let out at break even, but it was pretty late in the day, so hard to do that. But anyways, yeah, and then we sold off into the end of the day. For always in, I thought it was probably always in short on 6 and stayed always in short until 28. I don't think we quite went back to always in short here. Some would argue that 32 made the market always in short, but it was probably going to be brief. So I don't think bears sell again below here. Bulls might exit somewhere in here, but I don't think they sell again. Always in long here. Thought bulls exit, bears sell below this. Bears exit above here. And you get a big bull bar on 46. Yeah, maybe it's always in long, but bad follow through and traders exit. So, bears can sell again below 55 or 57, and it probably stayed always in short realistically for the rest of the day. But, it's really hard if you're a bear to hold through all of this. On the daily chart, really good follow through for the bears. This is, exceptional follow through. So we're going to see what we end up getting. I think bulls who, buy below these lows, are going to be able to scale in and make money. But this is pretty damaging to the bull case just overall and in general. On the weekly chart, strong close for the bears. It could just be climactic though. I do think the bulls who bought below this low are going to make money. So yeah, that's the day.